Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins-Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I'm excited to be joined by two very special guests of our own, Chris Neary, Senior Acquisitions Associate, and Eric Fitzgerald, Director of Acquisitions here at PassiveInvesting.com. Chris and Eric, welcome.
Thank you, Whitney. Thanks for having us.
Thank you.
All right, guys, before we dive into a portfolio deal, the stepping stone at Bridgewater and the banks at Bridgewater, a combined 296 unit portfolio in Myrtle Beach, South Carolina, tell us a little bit about yourself, how you got into multifamily, and what your role is today at PassiveInvesting.com.
Yeah, so I started in real estate in college, working in property management for a local student housing investor. I also worked for a company called Morgan Properties based out of King of Prussia, Pennsylvania. I moved down here to Charlotte in 2019, started as an analyst with a smaller firm in Charlotte, and then as an associate for a family office, and I was based here in Charlotte as well. Been with PassiveInvesting.com for about 2 years now, and as Whitney said, I'm the Director of Acquisitions, so I oversee primarily our multifamily and car wash teams, acquisition strategies, closing deals, and broker relations, and happy to be here.
This is Chris Neary speaking. So I started right out of college, actually during college with PassiveInvesting.com in late 2019, and COVID hit and that kind of slowed down, but actually it picked up pretty quickly after that. So I moved into a full-time role just under 2 years now. And that actually led to me working on the multifamily side. So I work with Eric hand in hand. I currently reside in Austin, Texas, recently moved from Charleston, South Carolina. And that's a little bit about me.
Awesome. Well, guys, welcome. Let's dive into the details of this portfolio. So we have the stepping stones at Bridgewater, and we have the banks at Bridgewater, 296 units combined in Myrtle Beach, South Carolina. Okay, so I happen to have a little bit of intimate knowledge about this deal, having worked with you guys on it. So it closed in December of 2022, but let's back up the timeline a little bit. How did we acquire this property? Like, how did we first hear about it?
So kind of a funny story. We had got on a call, I forget what month this may have been, but it was multiple months before the property ever hit the market with the developer himself and another broker who was trying to kind of drum up some deals. So had a good conversation, directly with the developer, ended up not making, a deal happen there, but that was actually when we first heard about the deal. And then it was, listed eventually in the next couple of months by a prominent brokerage firm here in the Southeast that we had a good relationship with. So it was a natural kind of progression for us to go, now to that major brokerage shop and try to pursue the deal that way.
Okay.
That was in June. It listed in June, fully marketed. And then that was actually a full marketing process. So that took multiple months is sort of the timeline when everyone had eyeballs on it.
And how many people or how many groups were we competing against in order to get an offer in?
I don't know how many offers they might have had. It was certainly, it was a fully marketed deal by one of the prominent brokerages in the Southeast. So there were certainly a lot of eyes on it for sure.
All right. So let's talk about at what point in time did we set foot on the property? And, was that before or after putting in an LOI? Let's kind of get a little bit more in the timeline here.
Sure, I could speak to that. So I set up a formal tour with the brokerage firm and the on-site staff for myself and actually our director of capital markets because he lives local to the area. So it was nice that we had two different perspectives. And that it was a hot day. So it must have been July, probably July. So maybe a few weeks after the initial full marketing package came out. At that point, we probably had it in the model and we were ready to get, on-site feelers for it.
Okay. And then were we on site before putting the LOI or was that after putting together LOI?
It was before. We were definitely on there before, which helped us obviously so we can see the state of the property. And actually for this one, it's a new one of the properties, the banks at Bridgewater was a new construction build. So we were able to see how far along they were and what was left to complete.
All right. So how did we structure our LOI?
Good question. That was actually up for debate. So since this was two properties, it was the same developer on both of them, excuse me. One was completed in 2021, which was fully stabilized, meaning it, had 95% plus occupancy. Whereas the newer, larger deal was 252 units, was just coming out of final construction and was in a lease-up phase. So we debated about whether we were going to do two separate LOIs or letter of intents, or just to do one. Since it was the same group, we were going to do the same timeline, more or less, so it's easier for on-site management, etc. And we actually went with one LOI at the end of the day, so one timeline, one grand purchase price. And just to simplify it a little bit, Eric, do you want to add to that at all?
No, yeah, I think that's exactly how we did it. And I think looking back, at least on the LOI stage, not a huge deal, but when we get into kind of the contract piece, we can talk about some of the differences in packaging two deals together versus separating them and what we might do moving forward.
Well, let's dive into that. So we have one LOI there. Talk to me about, that conversation. Was there any markups on the LOI? How many times did it have to go back and forth? Was that timeline to get to the purchase sale agreement?
Yeah, I want to say it's probably 2 weeks or so. And I want to say we didn't even do a buyer call on this deal because I think we already knew the sellers, and the brokerage company was a company that we had done multiple transactions with. So at the end of it, they ended up just, kind of giving us good guidance on where we were sitting, and because of the good relationship that we have with them and our certainty of close, we were able to get the deal.
That being said, there were multiple rounds of offers. We are still competing against other firms like ourselves, and that best and final phase, or whatever you want to call it, actually was a pretty long process. I think it was 2-3 weeks, or typically we would like to see it be rather quick. So just a little bit more context for you there.
So what actually sealed the deal for us on that particular deal? Like, what won us the deal over other groups?
I think it was, like I said, our relationship with the brokerage company. We had transacted more than a handful of times with this, same group and with these brokers. We had met them in person during the kind of offering process on this deal to kind of cement that relationship and our interest in the deal. We had done multiple tours with multiple people from our company. So that, on top of the fact that we already had a discussion and a conversation with the developer, many months before, I think we were just kind of the natural, safe closer kind of selection. And I'll let Chris add anything there too.
Yeah, I can give some color on, what was in the LOI to some extent. Timelines, I think we were pretty competitive on, even it being a lease up deal. I think we had a 30-30-30, meaning 30-day due diligence, 30-day closing timeline with a 30-day extension, which is an option to buy, of course. We also had some hard money on the line, earnest money deposit. I think it was $1 million up front, $1 million on the back end, with the front piece having about, I think, 200 of that million go hard. So, it's pretty strong LOI, especially in the time that we did close it. You had a lot of volatility in the debt markets, and I think certainty of close was definitely top of mind for the seller.
And so on that $200,000 that went hard, was that hard with the signed PSA? Was that hard after due diligence? At what point in time did that go hard?
Day one. So when we signed the PSA, the money goes hard. Yeah.
Oh, awesome. Okay. All right. So we've got this 30-30-30 signed PSA. We're now in that first 30 days due diligence. Walk me through how due diligence went. What was the timeline? Who was on the property? How did that go?
Yeah, so we had FCA, our property management company, bring their full SWAT team of property managers and lease auditors and maintenance people down to the property. And they're based not too far away from the property, so it wasn't too bad of a trip for everyone. But I was on site. Our asset manager, director of asset management, Brian Bornhorst, was on site. And what that looks like is just getting our hands and feet all over every single unit and every single crevice of the property, the grounds. So really kind of, looking at the property, what are some potential issues that we might come up with from a physical standpoint, also from a financial standpoint, doing the lease audits, making sure everything is being accounted for properly. Any units with pets, are they being charged a pet fee? So we go in every unit, we check for pets, signs of pets. And it's basically a 2 or 3 day extravaganza of just looking at every single lease, every single file, every single unit, and also going up to the riser rooms, looking at HVACs, all kinds of stuff.
Were there any surprises?
There's always something that will surprise you. I think on every due diligence walk that we've done, there's always something there that you don't account for, which is why it's important on the upfront to budget conservatively. If there's a value add plan, even if there's not a value add plan, put in a good chunk of capital that you can go in with and be covered if there is something that you didn't expect, which there always will be. And also, so you're not one of those people that go in and see something that maybe costs 50 grand and you go for a retrade on $100 million asset, because something, you have to take care of something. We typically don't like to nickel and dime, and maybe 50 grand is a bad example of a nickel and dime. It may be closer to like 10 grand or, 5 grand or something smaller that we wouldn't necessarily make a big fuss about. So specifically on this deal, there were a few kind of drainage issues that we had to work through, a few kind of landscaping issues. It was, I believe, right around the time that the hurricane came through, right? So yeah, there were a couple issues from the hurricane. Luckily, nothing too serious. It's always good to visit a property during a rain or right after a rain, because you see where the water flows, where the potential issues come up. And so those are kind of a few issues that we found on the property.
That's sage advice, right? Visit if you can line that up, visit during some inclement weather, especially if it's inclement weather you're concerned about. Mm-hmm. All right, so no real surprises, physical surprises. This is a lease at play. Were there any financial, how did financial due diligence go? Were there any surprises there?
I want to say on this specific deal, there weren't many issues on the lease audits. I think, there's always, deposits might not match up or something might not match up. You want to make sure that residents are being screened properly so that their income requirements are, 3.5 times a monthly rent. You want to make sure that all lines up. And typically with a Class A type properties with professional management, you don't see a huge amount of issues there, but it is definitely something that you need to look for. Criminal background checks, credit scores, all that kind of thing. You want to make sure are in the lease files, they're being screened, that kind of thing. But Chris, anything you can remember? I don't remember too many issues on that side of things.
No, definitely not. One thing that is typical on these is that they're not fully collecting pet rent for whatever reason. We'll do these walks and we'll notice that there is 2 cats or something and that person's not paying for it. So lining those up based on your on-site walks versus your lease audit, and just matching the two is always something fun to do. But no, nothing major financially.
All right. Now, it seems like during this due diligence timeline, things are running really smooth, but you've already alluded to that if you had to do it all over again, you might not have structured the PSA the way that you did. Talk to us a little before we move off the contract piece. Give us a little bit of insight that if you had to do it again, how might you have done it?
Yeah, so when you're working on a portfolio of deals, the seller is going to want you to have one contract and you're going to want to have separate contracts just because of the incentives that go along with that. So if we had separate contracts, that gives us a lot more flexibility. If, for example, there's an appraisal issue on one of the properties, or we find something in due diligence that we don't like, and we want to pull out of one of the properties but still proceed with the other property. Now, from the seller's perspective, they want to sell these as a package. They were not really interested in a one-off transaction, so there's kind of a give and take there. And on this transaction, we actually ended up doing one contract and one transaction. Ended up working out in the end, but certain aspects of the transaction, on allocations and different kind of conversations we were having, two contracts as a buyer is much more preferred. Again, you might not get that from a seller though.
All right, well, let's move on to the financing piece. And we haven't actually touched on it yet, but what was the purchase price of this property?
Sure. For the combined two properties, I have it written down here, it was 78.4 million. So 296 units. Do the math on that. Yeah.
All right, so okay, so we got just over $78 million, right?
Yes.
Okay, so how did we finance the deal? What did that look like? Especially with the two properties in the portfolio.
Yeah, so we've got a director of capital markets on our team named Ed Gilmer, and he does a great job on getting us the right kind of debt for all these different deals that we do. So particularly on this deal, we decided to do a combined loan to try to, because one of the properties was stabilized, one of them was in lease up. And we found we could get more favorable terms by taking some of the cash flow from the stabilized property and applying that to an overall NOI for the entire portfolio to get better LTV, a better rate, but better terms overall. So we ended up going private debt fund route, to where we actually synthetically fixed our rate. Maybe Chris, I don't know if you have the specific details, but I know we synthetically fixed our rate to where our all-in rate was going to actually be less than what it would be if we went a true fixed rate deal. We also have the flexibility over, I believe, 3 years to refi or sell. So we fixed that rate for the first 3 years. So we're able to kind of ride through any potential storm. But we're also able to get significantly better LTV and better rate than we were if we went agency or some other route.
And I can give some context or numbers to back that. So at the time, agency was pretty high. The treasuries were bouncing around like a heart rate monitor, and it was just really hard to decide which day to rate lock. If we were going to be at the right occupancy threshold or NOI. So just to give those numbers, so agency was actually penciling to a 6.25% rate at about high 50s leverage, so 57, 58%. Whereas the private debt fund we were able to fix that rate or rate cap our rate essentially at 5.75. So it's 50 basis points lower and actually at a higher LTV. We were anywhere, I think we were like low 60s, so it's like 62.5 or 63%. So we were able to get more financing at a lower rate going that route, and actually gives us a little bit more flexibility on the back end. So typically with an agency, you'd go defeasance or yield maintenance, which locks you out of a sale for potentially 7-10 years. Whereas with this bridge debt, once we build up this NOI over these next 2-3 years, we can either refinance or we can sell the property. So it's just a little bit better route, especially with the timing with the debt markets. So thanks to Ed, we figured it out.
And I know, listeners are going to have the question of, well, what did you buy the rate cap for? And even with the rate cap, we actually got proceeds towards the rate cap. So our all-in amount was much higher on the private debt fund loan amount, all in, than it would have been from an agency loan as well.
All right, and so 3 years, synthetically fixed, as you call it. Were there any extensions to this debt?
Is it 2 1-year extensions, Chris?
Yes. Yeah. Usually a bridge debt structure is a 3-1-1, meaning 3 years with 2 potential extensions, or a 2-1-1-1, just for context.
Okay. So 3-1-1 on this particular debt. Okay. So we got some, insight into the capital stack. I know we raised on this deal. So let's talk about how we structured with the raise with our partners. So how much did we lock in with debt? And then how much did we raise for this particular deal?
You might be able to better answer that than us. I'll have to check. I don't have that number written down exactly, but let me dig in here quickly.
Probably roughly like 35 or so million of equity.
Yeah. Talk to me how we structured that raise with our partners, our limited partners.
So we do all LP investors. So you mean like as far as the split and what that all looks like? Sure. So a 30-70 split, GP being the 30, LPs being the 70. I believe on that deal, we projected somewhere between a 12 to a 15 or 16% IRR. And I believe on average on a 5-year hold, a 4 to a 6% on the cash on cash. So, as soon as we go under contract on the deal, we release the deal, we go through our due diligence, we accept investments, then we start paying out distributions on that deal.
All right. So and on this particular deal, we did a 7% preferred return, 70-30 to the investors. And we also had an IRR hurdle in there at 13%. So that just gives a little bit more context on the actual structure of the deal. Okay. So we talked about that. Let's talk about the fees on this deal. This is something that I like, touching on with everybody's deals that we talk about on the podcast. What were the fees that we took on this deal?
I believe we were at a 2.5% acquisition fee and a 1.5% asset management fee, and then maybe a 1.5% guarantor fee. I believe that's where we're at.
Yep, that's correct.
Awesome. Okay. Now we've gotten through the transaction, right? We've got through due diligence. There was $1 million, down on the front end, $1 million down on the back end, $200,000 that went hard. We're through due diligence. We're on our way to securing the lending. Were there any bumps in the road going towards closing?
Yeah, there definitely were. So this was, in the time period of, treasuries and interest rates kind of exploding through the roof. And, while we underwrite interest rate sensitivities on all of our deals, we certainly don't underwrite, 100, 125, 150 basis point increases. So, that happened, and there were deals falling out left and right in the market. And we had to have, a couple really, really difficult conversations with the brokers and with the sellers on what it's actually going to take to get this deal done in this new environment. And one thing that I think we do really well is when there's an issue in a transaction, we are completely transparent and upfront about the issue. We don't hide, behind anything, even if it's our mistake. We want the transaction to go through. We want to be the group that everyone remembers as being professional, fast, effective, and they want to do, another deal with us again. So if this developer goes and builds more units, which I'm sure he will, he'll remember us as the people who, even during a tough period in the overall economy, when deals were dropping out left and right, we approached them and we said, look, based on our new, based on the new interest rate environment, this is going to have to be the price that we get the deal done at. And if not, we'll bow out, we'll, kind of retreat, and, you can hold the deal and do as you'd like. And, that's also working again through the brokers and making sure they understand what's going on and being very upfront. And we actually got the feedback after the transaction that, they had deals dropping out all over the place, people being shady, all these things happening. And, they really appreciated how we identified the issue and attacked the issue of, the interest rates rising higher than anybody could have thought. So we had to do a pretty significant retrade on it. I believe we ended up, correct me if I'm wrong, Chris, somewhere around 4 million below the purchase.
Higher. 6. It was like 5.5 million of a price reduction.
I know we asked, as our kind of first negotiation tactic, we asked for quite a bit. The real number was a little bit lower than that. So we ended up settling, like Chris said, around 5.5 million, which actually improved our returns quite a bit. And we were able to still be conservative with debt and kind of make sure that the deal still worked out. So we were glad to kind of come to that, solution with everybody involved.
Did that push closing at all in order to negotiate that type of retrade?
No, it did not. We kept that kind of within the general time frame. I
We did
know.
execute the extension, which was not cheap. I think it was another 200 or 250,000 to purchase that extension, but it did allow us to stay within our timeline. So all in all, it was actually quite a long process from initial engagement, the conversation, to initial marketing to closing. It's almost a 5-6 month period of time, just based on how long the process was and us using that extension. So just to put things in perspective, when you're underwriting a deal in early 2022, the environment, the rate environment, or the treasuries are just wildly different. So as Eric mentioned, that happens sometimes, and a lot can change.
Yeah, that is a lot of runway for a lot of things to change. But what I appreciate about stories like this, and this story that you guys are telling is certainly not the only one that we've heard here on the podcast, is the tenacity to be able to find a solution and work with the sellers and brokers in order to get the deal across the finish line. So kudos to you guys. All right, so I have a few kind of like wrapping up questions here. One of which I always like asking, because not all the obstacles come actually during the purchase sale timeline, right? Like closing happens and then you take over the property in the first couple of weeks. Were there any bumps in the road with taking over the property?
Yeah, so even I think we can just touch lightly on it. One of the things that we did actually right before closing was we got our property management team into the property. We didn't, we're not going to name drop anyone or throw any, dirt, but, there were things that we would have liked to seen on the management side, to where we were able to get FCA as part of our retrade, repricing negotiations. We were able to get FCA implemented into the property, to put our systems in place, put our leasing strategies in place. And we saw significant improvement in the lease up of the property, and obviously the takeover was a lot easier because FCA is already in there. So that was one thing that we kind of ran into closer to closing. And then, after closing, there were a few, punch list items as far as the construction completion that we had to work through and make sure we're being completed. But based on how long and how fun that transaction was, it's been a relatively smooth takeover process since then.
All right, well, fantastic. So was there, just in wrapping up, was there anything that was easy that you thought was going to be easy that actually ended up being hard? And was there anything that you thought was going to be hard that actually ended up being pretty easy in this transaction?
I thought it was going to be easy as underwriting these deals, but it turned out to be quite a challenge in figuring out the blend of the two at different purchase prices, and figuring out if it's best to underwrite in one model, if it's going to be one contract, and just figuring out the balance between the two, which inevitably we figured out, and it turned out to be two separate underwritings and essentially two separate deals. But figuring out that piece took some time, and obviously we have a great analyst that helped us work through that process. But for me, I thought it was gonna be a lot simpler, and it has been in the past. This is probably one of the more challenging deals to underwrite.
Awesome. Well, guys, thank you so much for, sharing your insight and knowledge with us here today. If anybody wants to reach out to you, what's the best way that they can get in contact with you?
Our first names at passiveinvesting.com. So Eric and Chris.
Fantastic. Well, Eric and Chris, again, thank you so much for spending your time here with us today. And we look forward to reconnecting on future deals.
Thank you, Whitney. Thank you, everybody.
Thank you.